Ladies and gentlemen, fellow partners in business, entrepreneurs, I'm here today to talk to us about choosing the right company to invest in. If you are to choose a company to invest in, maybe in the securities market, Nairobi Stock Exchange, or London Stock Exchange, or Johannesburg Stock Exchange, how do you choose the right company to invest in? And I want to tell you some of the people that have been successful in investment in corporates. This is the area of corporate investment, and you need to think about investment banking, about funds management, and all those kind of things. These people look at certain things, and it's very important for you. I know many of us really invest in stocks, and we venture or we invest in companies. You may find a company that is doing very well. For example, in the listed companies in the stock exchange, which one do you choose to invest in? Now, I want to share with you some things. These are my own thoughts. There are five things that you need to consider before you invest in an organization. Number one, you need to understand the business that the company is involved in. Do you understand what are they doing in? How is the industry like? What is the economic environment? The business that they're operating in? How is the competition? What is the growth potential? How is the size of the market? And how do you see the outlook of that business? Do you understand it? The political, what I call, you need to have a pastel, the political environment, the social, legal, technological environment, the economic environment of that business. Does it make sense? So you need to consider the Michael Porter model. Look about all those things that affect the ease of entry, the ease of exit, the competition, and all that needs to give you a bit of understanding of that business. How do they do it? What's their business model? How do they make money? Who are their customers, and is it a growing market? Who are their competitors? So understand the business. You need to understand the business, have an appreciation of that business, understand where it's coming from and where it's going. The second thing that is very, very important as you think about an innovate a business, let it be a business what Warren Buffett calls a business with distinct characteristics. It must have certain features that are very clear. For example, if you are investing in a bank, you know very well, you can understand it, you can see this bank is here, it's serving this market sector, it's likely the economic environment is looking like this, and it's going like this. If it's in energy, you know very well, energy is growing this way, there's a demand which is linked to the economic growth rate of a country, there is access level that country has to electricity. Maybe it's 50% that have got access to power, and therefore there are additional the potential or upside growth potential. The tariffs are this way, or the price is like this, the competition is like this. So you need to understand the various characteristics of that business. The third thing that I think is important for you again is also you need to understand the leadership and the management of the company. A company is led by people, and there are those who lead the organization, who manage it. So you need to understand who is the CEO, who is the CFO, who is the chief operating officer, who is the technical person, what's the top leadership, who is the chairman of the organization, how is the board structure like, who is sitting in the board of that organization. So understand the leadership of the organization, because that gives you a sense of the trust and the confidence you can have in it. If it's being led by crooks, then you're likely to lose money in the long term. If it's led by men of integrity, men and women of integrity who are known as business leaders, then you can have some confidence because they have made good decisions before. They can make good decisions again. They are not based on emotions. They are directed by clear planning, clear growth strategy that taking them from A to B and to C, and they have a destination that can be seen very well. So you need to understand the leadership of an organization. The fourth thing that you need to understand is the performance of the organization. The performance of the organization. And performance of the organization is it, how is the turnover? Is the turnover growing? How are the costs like? Are the costs too high? Are within expected range? And then you begin to look at certain key performance indicators. Some of the key performance indicators are performance-related indicators. One of the key one is EBITDA, earning before interest, tax, depreciation, and amortization. what is EBITDA like? And EBITDA should be very reasonable. Is it 40%? Is it 50%? Is it growing? Is it 60%? And what ratio of that EBITDA is? And it should be an area, because that's really what's coming from the business. The business they are doing generates earnings that before you take into account tax, depreciation, amortization, and all this, that is really the output, the outcome of that trading. So understand that. Then you also need to understand what is the return on assets, the asset that and what does that compare? Because if you're going to invest in that company, you're becoming an owner, and you have alternatives, investment alternatives in the marketplace. You can invest in risk-free bonds, treasury bills in the marketplace, but you choose to invest in this company. So you need to be able to recover an equivalent of a risk-free return by invest from the treasury bill or treasury bond, plus a delta which covers a risk premium, plus your own margin for taking that risk. So you should be talking about, if treasury bill is at around 9 or 8%, then you should be talking about maybe something like 16%, 15 to 16%, or 14 to 16% as your return. You could even have a higher ratio. So that will depend on who you are. So what's the return? What are is it return adequate on the assets? What's the return on equity that you're getting into that? And also you need to talk about leverage, which measures a bit of risk in the organization. How is the debt equity ratio? Are they highly leveraged? Do they have so much debt? And if they have so much debt, what is the risk associated with that? Because debt will affect interest. Debt may lead to also investors and lenders, if they don't perform well, taking ownership of the company and taking it over. So you also must look at the leverage. You also need to look at things like a return on assets. You need to look at price earning ratio. What's the price that you're paying for it? So the fifth thing that's important is that it must be at the right price. So the price that you're buying a share in a company must be the right price. Is it the right price for you? Is it value for money? So price earning ratio, the price that you're paying compared to the earnings, how many times are you paying for it? So all this net book value, the book value, all this you must consider. The adequacy of the price that you're paying, the reasonableness of that price. You must also look at the growth rate of the organization. What is the percentage growth rate of the top line? Ideally, you expect companies to grow a double-digit growth every year, so a 10 on 10% or less. But look at that growth rate. Look at other things that the covenants. You need to, are there covenants? Are they mortgaged and those kind of things? So all those are things that you need to consider when investing in a company. This has been your partner in business and growth, FCPA John Mudanye, talking about factors to consider before investing in a company. Please remember to subscribe. Press subscribe. You can find me, subscribe to my YouTube channel. Press also find me in Facebook. Find me in Instagram. Find me in LinkedIn as John Mudanye, FCPA John Mudanye. Thank you, and God bless you.